right, markets look like they want to rally again. 30 minutes until the start of the cash trade. I'm Matt Miller.
I'm Danny Berger. Bloomberg Open Interest starts right now.
Coming up, from UPS to UnitedHealth, investors wading through a flurry of corporate earnings ahead of the big tech parade.
And in those earnings, mounting layoffs, UPS, Amazon, Paramount, among the companies announcing job cuts in the last 24 hours as corporate America tightens its belt.
Also targeting 7,000, Wall Street maps out the S&P's path to new highs as sky-high expectations become the base case.
So many earnings to sort through and a lot of announcements, Matt. I have one company that did both of them. It was PayPal. They announced a raise and a beat, but that's not what has shares higher by almost 9%. It's another OpenAI partnership. PayPal, the first company to add its digital wallet to ChatGPT. PayPal also raised its earnings guidance. They weren't the only one, Matt. You also had Adobe announcing an OpenAI partnership. You say OpenAI and congrats, your shares rally.
Yeah, and they need it, right? Because they've been massively underperforming this market, as has UPS. But it smashed Wall Street's profit expectations and says it's cut 34,000 jobs so far this year. As a result, these shares, also big underperformers, are finally getting a boost, Danny.
Let's get more on UPS. Joining us now is Bloomberg stocks reporter Matthew Griffin, and he's been following this earnings report. Matthew, good morning. Great to have you. How much of this about UPS outperforming and the profit expectations is about the underlying business doing better versus just slashing costs and jobs?
Danny, thanks for having me, and that's a really good question. The answer is kind of in the middle, is that these stories are really tied together this year. And for the last few years, UPS has been facing some pretty significant challenges. You have competition from Amazon, you have higher costs, you have pressure on the volume of shipments that it's seeing. And so in response to these challenges, the company has set out to cut costs and to cut jobs. We knew that they were embarking on this cost-cutting push. They said they wanted to cut 20,000 jobs, but there were questions about the speed that those efforts had achieved and whether it would be fast enough to kind of catch up as they cut business with Amazon, for example. This report is really soothing investors' worries there. They cut 70% more jobs from their operational workforce, that's their drivers and their package handlers, than they previously said, so 34,000 jobs, which is a sign that those cost-cutting efforts are going well, and that ultimately flows back into the underlying business here.
How are they going to be able to continue operations, if the economy continues to grow with 34,000 fewer employees? Is this about cutting out low-margin deliveries like Amazon packages?
Exactly. So UPS is not necessarily saying that we want to do less business in the lines of business that are strong for us. They're saying, and they've said this year, we want to reprioritize into businesses that are more profitable. So though Amazon, coming into this year, that's their largest customer, but also those shipments are lower margin. And so that's where you get this push to cut that business. And that may be the plan here, is that there's room to add, but you don't need the capacity, you don't need the workforce to handle those shipments that weren't as beneficial to the company.
All right, Matthew Griffin covers UPS for us. Thanks so much for coming on set. As Matthew mentioned, UPS is not the only company announcing job cuts this morning. Amazon announcing it's going to eliminate itself roughly 14,000 corporate jobs. These cuts include roles in logistics, payments, video games, and cloud computing. Joining us now is Bloomberg Tech co-host Ed Ludlow. And Ed, this is a massive, massive employer. So 14,000 isn't a huge amount, but what's it about? Is it because we've just gotten some major job cuts only a couple of years ago from Amazon? Is this about trying to offset the hit to margins from tariffs, or is it about replacing jobs with AI?
It's about bloat, really. 14,000 jobs is less than half what Reuters reported it would be yesterday, right, which was a 30,000 figure. But even 30,000 in the scheme of the 1.5 million employees isn't that much. Amazon communicated that this is about cutting bureaucracy and layers of middle management. The difficulty for the market is that previous signals from Andy Jassy, the CEO, made it about AI. So in a world where AI is more pervasive internally and as a sales product, that would have some impact on roles. But in the communication that came out overnight, in the confirmation of the 14,000 number, it was much more simple than that. They're bloated in certain areas. Sources told us that it is quite wide-ranging, you know, everything from the video games offerings through to payments, services, etc. But flatten the management structure is kind of what Amazon's focus is.
Matt and I were talking yesterday, Ed, about a story from The Verge that came out last week where Amazon had hoped to cut 600,000 jobs over a long period, but because of what they see as AI replacing things. We've also had job cuts announcements in tech from Meta, for example. You're talking about very straightforward job cuts to streamline. Ed, when does that start to converge with technology replacement?
Yeah, so remember that a part of Amazon's story is the history of what happened in the pandemic. You know, there was a period from the year 2020 through to 2022 where the overall headcount basically doubled. But then you have to distinguish between fulfillment and logistics roles and corporate roles. These 14,000 jobs overnight are corporate roles, right? Managers, not people literally physically moving goods. The report that you're citing talked about a world where Amazon's investing heavily in robotics. We know they are. But like many things in the world of real world or physical AI, this is something distant in the future. You know, right now they're just kind of showing us what they're creating and playing with. It's not a 2025 story that every action in a fulfillment warehouse or regional distribution center on the Amazon.com side. Because always remember, like, cloud is the majority of operating income. We're talking about the much lower margin e-commerce business. Like, robots are one day, but they're not 2 day.
Ed, I just had a trader message me a GIP graph of ASML shares. They've taken a dip on your scoop with Ian King that a Peter Thiel-backed startup is going to try and challenge their sort of lithography dominance. What do we know?
Right. Okay, so this is a company called Substrate. It's based in San Francisco. It has been in stealth for a number of years and out of the gate has raised about $100 million at a $1 billion valuation. It has a new form of lithography machine where the light source is a particle accelerator. By comparison, ASML's machine is extreme ultraviolet light. But what Substrate was telling me is that every component of their lithography machine is done in-house by them. They have not worked with any other tech companies. The images that you're showing are the wafer patterns. And basically, read the story, but what they're demonstrating is that the scale of those features on your screen are as good or better, sharp or as sharp or sharper than what ASML's high-NA lithography machine is able to achieve. But again, the business plan is very different for Substrate. They want to not sell these machines to one of the chip manufacturers. They want to be a chip manufacturer, be the TSMC of America, an American foundry. And that is a long shot, to put it mildly.
All right, Ed, thank you so much. That's Bloomberg Tech co-host Ed Ludlow and the Substrate CEO James Proud will be joining Ed and Caroline Hyde on Bloomberg Tech at 11:30 a.m.
That's an
Eastern
angry picture
this morning. He's a serious dude.
That's very serious.
Got to be serious if you're going to be on ASML. Now, in other very serious news, this just crossing the wire, a new deal in Pact between Microsoft and OpenAI. It's a new stake in OpenAI's PBC. What does that mean? Well, joining us is Bloomberg Tech co-host Caroline Hyde. And Caroline, with these new agreements, first of all, Microsoft immediately jumping on this news, but I just looked through the headlines, and I'm going to be honest, a lot of it is like a foreign language to me, but it just shows the two are coming closer together. What exactly is this agreement?
We knew that a memorandum of understanding had been signed and the details are getting close for this public benefit corporation, that's the PBC bit, that ultimately OpenAI is forming. It wants to be a for-profit business. It was founded as a not-for-profit. The not-for-profit will still oversee OpenAI's public benefit corporation, and now we try and work out who has stakes in what. We understand Microsoft has $135 billion overall valuation ownership of the public benefit corporation. That's bigger than OpenAI's. We understand a few months back, Brett Taylor, the chairman of OpenAI, put out a statement that the overall philanthropic arm of OpenAI would hold a $100 billion valuation stake in the public benefit corporation. But remember, they've raised money from others. Thrive, for example, is in there. They will get a stake in this PBC, as it's known. But what's interesting is that OpenAI has still got a contractual obligation to buy Azure, to buy cloud from Microsoft going forward, to the tune of $250 billion worth of Azure services. But this is also talking about how once AGI, once artificial general intelligence is hit, in whatever form we decide that that is made, what happens then? Because this was always the deal between Microsoft and OpenAI. When Microsoft first pumped money into the company, it was they would have exclusive rights to OpenAI's overall IP until AGI was hit. Well, now we start to understand really what's going to happen in at that particular point as well. And they say Microsoft retains IP rights, intellectual property rights, Azure API exclusivity until AGI. But OpenAI can now jointly develop some products with third parties. You've already seen that happening. OpenAI was starting able to get cloud from others, like Oracle, for example, like Google, because they couldn't just get enough cloud from Microsoft. Microsoft, in turn, is starting to offer Anthropic within the overall Copilot offering, not just OpenAI. So these are the new terms of the deal. We knew this was coming, and this is a forward-looking relationship, and that's why there's such a sigh of relief, because many had wondered what on earth would happen when OpenAI did indeed solidify that public benefit corporation angle.
I mean, so they've agreed to buy $250 billion worth of services from Azure, which has annual revenue of $75 billion. So they're essentially agreeing to buy, more than 3 years of what Microsoft makes in all of the rest of its businesses in cloud. That should show you, I don't know the timeline, but that should show you the scale.
Yeah, that's the thing that we need to dig into is like exactly on what time this contractual incremental service.
If it's in 5 years, that's massive. If it's in 10, it's less so, right?
$250 billion is a lot, but think Sam Altman is spending $1 trillion at least in terms of overall AI infrastructure. So he's seeing that his cloud compute needs are going to be enormous for the next decade or so. And Microsoft's going to be a key player in that.
But there's also this weird thing where they're like, we've taken an $130 billion stake in OpenAI, and by the way, because of the share price raise, they've also created almost that much amount of market cap. It's like they're creating money out of thin air and investing said money.
Are you trying to hint at an AI bubble again?
Well, okay. Should we talk about the other thing? It's Microsoft announcing an OpenAI partnership or stake. It's PayPal.
Yeah.
It's also Adobe. Every single one of these companies are like, we're working with OpenAI, and this is what happens to the share price.
Just think about a couple of years ago, anyone would say we're doing something with NVIDIA and your share price would pop. Now anyone says we're doing something with OpenAI and their share price pops. I mean, sometimes you're giving equity to OpenAI, like in the case of AMD, and their share price absolutely walloped higher on the back of that deal. And so, yeah, PayPal's saying, look, we're going to integrate our payments ecosystem within OpenAI. We're going to also use OpenAI within our own business a little bit more. That's sending PayPal surging. But Truist, analysts over at Truist saying, sorry, I think eventually every payment form is going to be in these general chatbots.
Exactly.
Look, already Etsy's got a deal, Shopify's got a deal, but now really PayPal's trying to be out there saying we're thinking agentic AI for our future. They've already got a deal with Perplexity, they've got a deal with Google, and now they're doing it with OpenAI as well.
I mean, keep in mind, you'll be able to use, I'm sure, your Visa and MasterCard debit cards.
I know you're going to be wanting to use that locked up
You'll
Bitcoin.
be able to use your Amex. The thing is, like, PayPal gets this boost today, but those shares over the last 5 years are down 63%, while the S&P has risen more than double.
Yeah.
So, I mean, it's hard to underperform this much. You know, a real company can hardly do this badly. So,
well, buy now, pay later came into the ecosystem and started to erode in terms of market share. And really, that's what the CFO of PayPal is speaking to, that it's a whole new way of doing business that they've seen. Consumers want to pay in different ways. PayPal used to own really sort of the monopoly on when you went online and wanted to pay for things. Suddenly, you've got a myriad of buttons, but they want to keep on building up Venmo, for example, and monetize that. And they've actually shown and brought out for the first time actually what their billions of dollars of revenue will look like for Venmo for this year. They have they've raised their full year guidance. They are trying to do a turnaround under the new CEO. And I think they're starting to show that incrementally he can make these sorts of deals. But yeah, the fundamentals need to change. And they're also talking of a US consumer that's under duress right now and that payments are starting to come down in volume. They just want fewer but bigger transactions over at PayPal.
All right, Caroline, a huge wrap. A lot going on. Obviously, you've got to get back to your desk and
we're changing the whole show.
And work on Bloomberg Tech after these Microsoft headlines. Caroline Hyde anchors that program with Ed Ludlow. Kicks off at 11 o'clock. Right now, let's get a check on futures. We've got just about 15 minutes to go until the opening bell. And of course, we hit all new record highs on nearly every benchmark index yesterday. Even the Russell 2000 eked out a record high yesterday.
And the equal weighted also had a record high yesterday. By the way, the S&P was little changed when we started this show. What's moved it up almost 0.25%? It was, you can see it exactly on the line of when that Microsoft deal was announced. It's such a huge part of this overall market.
It's true.
Now.
Actually, Joe, bring up a GIP of just the S&P index, just the benchmark index, the futures, and you can see this huge spike with the Microsoft OpenAI announcement. So it's not just that it drives PayPal, a stock that has underperformed by 170% over the last 5 years, but it drives the whole market, which is up 18% year to date.
And it's moving, this is the kind of thing you'd expect to see after a macro jobs release data that looks really good, right? But that's not what this is. Driving that spike higher is an agreement between OpenAI and Microsoft.
Wow. All right, some of the other movers we're watching. UnitedHealth boosted its profit outlook and expects growth in 2026. That firm has struggled this year amid a number of problems, including a federal criminal probe, and it's now up 3% in the pre-market.
SoFi, they're also gaining this morning. They boosted their earnings forecast. Fee-based revenue jumped 50% year over year. They added they expect to add 3.5 million members into this year. It's also leaning into stablecoins and crypto offerings.
And Royal Caribbean issued an underwhelming forecast as rough weather and the closure of an exclusive destination in Haiti will impact results. Remember, we're preparing for a massive Category 5 hurricane to hit the shores of Jamaica.
Coming up on the show, top executives from Wall Street dismiss fears of a brewing credit crisis. Goldman Sachs CEO David Solomon arguing he doesn't see any systematic risk looming. We're going to show you some of his remarks. That's coming up next. You're watching Bloomberg.
Let's get now to high interest. Look what's making headlines around the world. President Trump is wrapping up his Japan visit with a dinner of top CEOs that includes Apple's Tim Cook, OpenAI co-founder Greg Brockman, SoftBank CEO Masayoshi Son. Trump praised the new prime minister of Japan, Sanae Takaichi, and pledged to be there for Japan. The two leaders vowed deeper defense and economic ties with Tokyo, outlining $550 billion in U.S. investments in energy, AI, and minerals. The president is now going to head to Seoul and then San Francisco for the APEC summit. Meanwhile, President Trump's media firm is entering prediction markets, unveiling a Truth Social feature that users can use to place wagers on elections, inflation, and sports. The venture, called Truth Predict, has backing from Crypto.com. It extends Trump Media's crypto push as rivals Polymarket and Kalshi see record trading. The CEO, Devin Nunes, says it will democratize information by turning free speech into market foresight. That's amazing marketing. Goldman Sachs CEO David Solomon said he doesn't see systemic risks in credit markets despite the collapses of First Brands Group and Tricolor Holdings. He spoke with Bloomberg's Jumana Bersetchi at the Future Investment Initiative event in Riyadh earlier.
I don't see anything in the context of a handful of bad credit situations that's leading me to say that we have a systemic issue around the corner.
Yeah.
Unfortunately, lenders make mistakes. There is fraud in markets. And that's something that as lenders we all have to try to protect against. But we should not be fooled by the fact that this is a very robust credit environment. Credit spreads are tight. And when we do have a cycle, which probably will come when there's an economic slowdown, there will be losses, and we'll feel that across the economy.
Striking a different tone than perhaps JP Morgan's Jamie Dimon. Coming up on the show, Moneta Chief Global Market Strategist Aoifinn Devitt discusses earnings revisions and the rise of job cuts this quarter. This is Bloomberg Open Interest. The bull case for the S&P 500 at 7,000 is quickly becoming the base case heading into the final months of the year. BlackRock CEO Larry Fink says the U.S. remains the place to stay heavily invested. He spoke at the Future Investment Initiative in Saudi.
Money is going to move around all the time, but I would say most global investors have a very large overweight in the U.S., and I think that's going to be the place to have your overweighting for at least the next 18 months.
Let's bring in Moneta Chief Global Market Strategist Aoifinn Devitt. Aoifinn, great to see you this morning. And everybody is bowled up that we're going to get something like a melt-up. There's a lot of event risk just this week between big tech earnings, between the Fed. Can anything stand in the way of this market and 7,000?
I would say at this point, maybe 7,000, yes, there could be some profit taking at that level. But where would the negative surprise be? We've already had a bit of a storm in a teacup around tariffs. That now seems to have eased given the positive signs coming out of these summits. We know that earnings or expectations have been very well managed. Therefore, to beat on the upside is probably not too difficult for these large tech stocks. So that's certainly looking positive. We've already been dampening down the talk of cockroaches in the credit arena, and that's probably putting some investors' minds at ease. But what we still don't know, and what I find intriguing, is why gold has come off. Because essentially all of the risks that were there driving the increase in the gold price, none of them has gone away.
I was actually wondering about that myself, but I figure it's still almost $4,000 a troy ounce. Like, it doesn't mean everyone has sold it just because it's dropped below that big round number, right?
No, certainly not. And some of the speculative interest has probably come out of that. And there's been some profit taking. Anything that's up north of 60% year to date, there's certainly ripe for profit taking. But what I do think is important is the sense that this has come off because maybe some of the risks have dissipated. And the risks, I think, are more macro risks around gold, such as the fiscal debt, etc. So not something that has really gone away at this point.
All right, Aoifinn, we'll have more coming up after the market open. That's Moneta Chief Global Market Strategist Aoifinn Devitt.
We are moments away from the start of trading, and there have been a flurry of announcements, including one from Microsoft and OpenAI, that have really boosted this market higher, at least in terms of the futures. You can see we're up 0.25% here, and the NASDAQ futures up 1/3%. A record on a rally, or rally on a record, I'll say, again, as I said yesterday, after we hit all-time highs on nearly every benchmark index yesterday, or at least everyone that I've checked so far, we're rallying further. This is pretty cool. Andrew Ross Sorkin ringing the opening bell at the New York Stock Exchange in honor of his new book, 1929. I'm in the middle of it. It's pretty incredible. The Financial Times, the Wall Street Journal, the New York Times have all given it great reviews. They say it's a work of scholarship and genius narrative storytelling. So check it out if you care about history. Pool Corp, speaking of history, 30 years listed on the NASDAQ. It's not been a great history, though, for investors. Over the last 5 years, it's down 20%, and over this year to date, it's down 14%. So it hasn't been really fantastic if you own the stock, but I guess still an incredible milestone. Right?
Yes, very well put, Matt. I love it. Look,
if you bought stock in 1929, by the way,
and probably do really well.
You're doing great.
You're doing so well.
Yeah.
And maybe it's a sign. We're talking about Andrew Ross Sorkin writing his book about 1929. Stocks are at an all-time high. What could go wrong? A stock to watch this morning, it is Microsoft, and it has moved the entirety of this equity index higher. Microsoft up 3.8%. It's getting a 27% ownership stake in OpenAI, worth about $134 billion. That was announced at the top of this hour. And this thing about this market, you announced something about OpenAI, and congrats, your share price will rally. PayPal is going to be the first company to add its digital wallet to ChatGPT. Those shares up 7.8%. They also had earnings that beat, but who cares? They got an OpenAI deal, Matt.
All right, UPS is seeing its biggest gain since 2022. It smashed Wall Street's profit expectations and has cut 34,000 jobs so far this year. Of course, this is just one more story of a company that has really underperformed the market. UPS has done very poorly over the last 5 years. It's been done very poorly year to date, and as a result, especially when you consider the S&P has doubled, right? The economy has grown so much, and yet UPS has done so badly. Over 5 years, down 37%, even with today's 10% gain.
So the bar is low, and that puts the gain in context.
Yeah, I mean, that's just the story of a lot of companies coming out with earnings today. Amazon, hasn't dropped, but it's underperformed the Mag 7. It's underperformed the S&P drastically, and it comes out with a layoffs announcement, and the stock pops. So that's one of the sort of storylines that we're following.
It feels like the storyline. Profitability is better at these companies because they're cutting jobs. And how long can that sustain this equity market?
Right. Well, we look forward to how also the Fed takes this in tomorrow. Let's bring in Moneta Chief Global Market Strategist Aoifinn Devitt. Aoifinn, are we seeing, now the cost of trying to drive stocks, trying to drive profits by releasing your workforce? Is that going to be the story of this season?
It certainly has been a message that has been rewarded consistently. CEOs know that. They know that this is the kind of good news is bad news is good news conundrum. And we spoke about cockroaches last week. This is really the scorpion story. This is a story of AI with a sting in the tail. We know that the sting in the tail around AI is definitely job losses, and we haven't fully digested what that means for the consumer. So just getting back to the sense of overweighting the US, right now, the story we heard Larry Fink speak about is this, have been records in the US. It is primarily a big tech and AI story. But I think it's interesting that you mentioned these laggards that have started to play catch up. If one is to overweight the US, it is critical that that is done in a way that is diversified across the spectrum, not to be overly concentrated in those big tech stocks, which are going to be more volatile after the kind of run-up we've seen.
And Aoifinn, we're going to be speaking to our in-house economists in the next hour about all these job cuts, but just looking at some of them that we've heard in the last month, and this really just scratches the surface. Okay, UPS, 34,000 cuts this year. Amazon, 14,000 target, just under 2. Applied Materials, 1,400. Charter Communications, 1,200. Nestle, 16,000 jobs globally. Sure, that helps with margins now. But at what point, and if any point, Aoifinn, does that weaken the overall economy, and especially for some of these consumer-driven companies, start to bite?
I think it's already biting, certainly at the consumer level. It's not been reflected in share prices. That is the divergence between the real economy and the stock market that we're seeing. And we know from the leaked memo from Amazon this week that there are far more job cuts on the horizon. There is a narrative that suggests that with cobots and co-pilots, that there'll be a lot of demand for AI engineers and people to run the robots or cobots. But I do think that that's really trying to mask the picture that we know the big driver of this is efficiency, is productivity gains, and the ability to displace workers. So the question is, what does that do to Main Street? And I don't think we've figured that out yet. The jobs data we're getting is patchy. We know that with the shutdown, there has not been the consistency there. So we have to think about this K-shaped recovery and how the lower end consumer is coping. They have been saved to date by the fact that fuel prices are low, food prices are somewhat in check. But we know that they have a little bit of participation in the stock market, so it's not completely divergent and foreign to them. But the lower end consumer will be in focus, and that's where we're going to see this pinching on the private credit side.
I wonder how AI, this story is going to play out, because we're investing now trillions, or forecast to invest trillions, and there's a lot of circular deals that may or may not make sense. But it does look like we're going to see AI destroy a lot of jobs. And that can't be good for the economy. Or is it kind of evened out by the fact that our labor pool is shrinking anyway?
Well, certainly it's shrinking with this new immigration policy and maybe with the aging population. But I think we know that the aging population, they do need to come back into the workforce. That was a big thing we saw change during COVID. The older population did not come into the workforce. They have to come back in now simply because inflation, despite the fact that the headline level is low, we know that experienced inflation, especially around healthcare costs, and that's why we're still in a shutdown, is because of disagreement regarding that. That is going to affect the lower end consumer. So I do think that the jobs numbers are very mixed. And what's important is that who is really controlling the narrative here? If the narrative is being controlled by big tech, we will get a positive spin on the job cuts, and we will get a positive spin on AI being good for the general public. I think it's important really to parse back the narrative, look at the fundamentals, look at the subprime auto loan companies that are not making it, and then go from there. So it is a problem. It's the sting in the tail. This is a scorpion story, not a cockroach story, but we really do need to be more nuanced in how we look at AI.
Yeah, a cockroach, I'll gladly squash. A scorpion, I would scream and burn down my apartment building, I think. Aoifinn, thanks so much for joining us this morning. Moneta, Chief Global Market Strategist, Aoifinn Devitt. Let's get back to that OpenAI and Microsoft deal, where Microsoft will ultimately own 27% of OpenAI. Microsoft also just crossing $4 trillion in market cap. Here with more details is Anurag Rana, software analyst for Bloomberg Intelligence. Anurag, what do we understand about this deal? Obviously, the two are already very much so linked, but it's this valuation. Are they taking a bigger stake in OpenAI? How has the relationship changed with the news this morning?
Yeah, I think the most important part for us is that Microsoft maintaining the intellectual property rights to their models and products. I think that stands out to us. The financial things is not that important, frankly, because again, Microsoft is not short of money, nor they are looking to make some money out of it. But having those rights till 2032 really protects their assets, their Copilot, from getting watered down, frankly, because their own models, they are not at par at this point, and it's only two models, whether it's OpenAI, Anthropic, or Gemini, but they're not going to go and work with Google. So it's that to us is the most important thing.
These companies, don't look that expensive. I think NVIDIA, yesterday I looked at the forward PE, it was like 42, and that was the highest among, other than Tesla, among the Mag 7. Microsoft is trading at 35, which is punchy, but I guess investors are just hoping that the earnings will continue to catch up.
See, Matt, I can give you a number of people who'll take the other side of the argument because, how much are they going to go revenue by? 12, 13, 14%? How much will earnings go up by? 12, 13, 14, 15%? And then you have to pay a 35 multiple for that. So there are enough people who'll take the other side of that argument that, why am I paying 35 times for a company that's going to grow earnings 14, 15 times?
Anurag, with these companies that you cover, that there's been this real fear of disruption from AI. A lot of the software companies, you had two of them, PayPal and Adobe, this morning announced partnerships with OpenAI, and you see a big rally. Is that enough to assuage fears that they're going to be replaced by AI? If you can't beat it, just join it and add it on to your tool suite offering?
See, we have said that for a while, that we don't think it's going to get disrupted, at least the large enterprise vendors. What they are showcasing right now is you can access some of those tools through OpenAI. OpenAI is one of the most popular apps for consumers right now. And if you can actually go out and tap into your enterprise workloads from that, that's really convenient. And the more OpenAI is showcasing that they will partner with the likes of Salesforce or Adobe, I think that's really good for, I think all of them, frankly.
All right, Anurag, great to get some time with you. I hope we can get you back on again soon because there's so much going on in the space. Anurag Rana, Bloomberg Intelligence, covers these mega cap tech companies for us out of Chicago. Coming up, UPS delivers a stunning earnings report and prepares more cuts. More on that next. This is Bloomberg Open Interest.
Get you some top calls, the analyst action that we're watching this morning. First up, Snap gets downgraded at New Street Research. The analyst there warning that the company could face perpetual declines in users as efforts to limit teen social media use take aim at Snapchat's core demographic. Those shares down 1.7% this morning. Next up, Wall Street reviews are mixed after Corning's third quarter results that fell short of expectations. Analysts highlighted weakness in the company's optical business. They also said that fundamentals remain solid, but high hopes for AI-driven growth leave little room for error. Those shares down 3.4%. Finally, UPS is surprising Wall Street, smashing profit estimates by cutting costs and jobs. Analysts say that the results prove that the company is making progress in its turnaround. Truist, for their part, says the company is set up for strength into the holiday season, Matt.
All right, so that's a stock that we're definitely watching, and we want to get more on UPS cutting jobs and boosting its outlook. We welcome Lee Klasko, Senior Transportation and Logistics Analyst for Bloomberg Intelligence. And Lee, this is a stock, as I've been saying this morning, one more of these stocks that's severely underperformed the benchmark index over the last 5 years and year to date. Is cutting 34,000 jobs enough to turn that around?
Well, I think it's part of the process, right? So UPS is on this journey, shall we say, of reshaping its network. And the reason why it needs to reshape its network is that, it had heavily relied on Amazon for volumes, and now they're kind of, as they would say, they're doing a glide path down of that volume. And that's just because it's really low margin business. And they're in the third quarter of a 6-quarter glide down. So we should see more volumes coming off. And what they're able to do now that they don't have this surge in low margin volumes is they're able to get rid of certain facilities, reduce headcount, and also those reductions are being driven by technology innovations that are helping the company be a lot more productive. Going into the quarter, I think investors and analysts were very cautious. They didn't really know what to expect because of the impact of the de minimis exemption, which was removed for all countries, a couple of weeks ago. And that obviously was going to have an impact on the business. But if you look at, where management is guiding on the fourth quarter as it relates to revenue and margins, it looks like the fourth quarter, at least for consensus, is at least this morning, there's about like 9 to 10% upside on the high end of that range that management provided this morning. So I think, it looks like management is executing on its plan. And we'll see, what that will bring in 2026.
Lee, how much are supply chains just still an issue for UPS, and one that will remain an issue despite some of the network changes they're trying to make?
Well, the good news is when supply chains are in flux, that's a good thing for companies like UPS because they're helping their customers. They noted on their morning call, their third quarter call this morning, that they're seeing a lot more customs business because the de minimis exemption was eliminated. Customers now need help getting their shipments cleared through customs, and they saw a surge of that. And because of the investments that they made in technology, they're able to do it more profitably. So they saw a surge in volumes, and those volumes were more profitable because they were really able to, a large percentage of that volumes were done electronically and really without a lot of human intervention.
Are the competitors doing better? I look at FedEx stock, and it's also not, a fantastic gain, actually a loss over the last 5 years also, but only 3%.
Yeah, so, I cover freight markets. I cover all markets, and the freight economy has not been good over the last 3 years. And that's really been a drag on most of these subsegments, and they've lagged the broader industries. As it relates to UPS, UPS has had, as we saw, it looks like they're executing on their plan. There were some quarters where, they came in short of expectations. But, what we view is when looking at UPS from this print, and we're I would say, most encouraged about is that, they're expecting a relatively normal peak season, which is really great because, going into the season, we were thinking that it was going to be a pretty tepid peak season. And they're telling us, in the investment community on their earnings call that most of their enterprise customers are expecting more normalized peak this year.
All right, Lee, thank you very much for that. Lee Klasko of Bloomberg Intelligence after UPS's earnings. Another earnings we're covering coming up. UnitedHealth sees growth in 2026 after a meltdown earlier this year. Initially, that gave a boost to share prices, but now they are falling in this morning's trade. We'll have more coming up next on Bloomberg Open Interest.
This is Bloomberg Open Interest. Quick check on stocks. We are looking at now losses on the S&P, but maybe this is just a breather after hitting all-time record highs on the S&P, the Dow Jones Industrial Average, the NASDAQ, the Russell 2000 yesterday, and those are just the American benchmarks. So right now, little change there. The NASDAQ still up about 0.3% after a slew of earnings and announcements, a couple of them related to OpenAI. Check out NVIDIA right now up 1.2%, so that's helpful for the NASDAQ. Should also buoy to some extent the S&P. Alphabet shares are down. Remember, we're going to get tomorrow and Thursday 5 of the Mag 7, including Alphabet report. Microsoft is one of them right now up 2.8%. It made an announcement with OpenAI that the latter is going to buy $250 billion in Azure cloud services from the former. Apple right now only up 0.1%. For a brief moment, if you blinked, you missed it. Apple's market cap rose over $4 trillion. I still haven't been able to graph it on the Bloomberg, but I'm trying. UPS is up 7.25% right now after raising its guidance as well as cutting 34,000 jobs. The market likes that. Not sure how the Fed will react tomorrow. And UnitedHealth Group right now, little changed, but there's some red on the screen, which is interesting, right, Danny? Because
Oh, now it's green, so it heard you and decided to defy you. No, but to be fair, it's waffling back and forth between gains and losses. When it opened, UnitedHealth opened up 4%. Now, it did beat Wall Street expectations for the third quarter earnings, and it raised its outlook for the year. Bloomberg Health editor Cynthia Coons joins us now. So, Cynthia, we can't decide what to do with this stock, but what did the results show us?
Yeah, so basically there was some good news, there was some bad news. The good news is that they talked about growth going into 2026. They raised their guidance a little bit. I mean, investors are a little shell-shocked. United's been a very predictable, steady, growing, beat and raise stock, and it sort of changed that narrative earlier this year. So this earnings looks like more of the old United. Obviously, it's only one quarter, so I think there's a little bit of people want to get a little more excited, but they know that this entire industry is under pressure. They mentioned some realignment charges on the call, so I think the stock may be tempered a little bit just as investors tried to really understand how they're going to chart a different path than they have been.
What does UnitedHealth need to do? They've had an awful year, right? At least in terms of the stock and also in terms of a lot of other things at the company, but it's down almost 30%. Do they need cheaper drug prices? Do they need higher premiums? Do they need different demographics? What are they doing wrong, and what's the market doing wrong for them?
This is a really, really tough industry, and it's interesting to see what's happened to insurance in the last year or so, because these companies used to be so predictable, and they grew a lot as government made a lot more healthcare available through ACA and subsidies and Medicaid, and a lot of that's getting pulled back right now. So it's a lot of kind of retrenchment for companies, and these companies that are in the business of forecasting not quite getting it right. And we've seen this with a lot of companies in the space. So I think for United, what they've already done in terms of pulling back expectations a lot, if you look at they're on track and for their earnings to hit a level that's quite low compared to where they've been. So I think really pulling back expectations is probably the best place they can start with. And then it's going to be execution. But there's a lot of kind of landmines out there. There's the ACA subsidies, maybe people falling off of those plans. There's the Medicaid cuts, and there are a lot of ways that, this whole industry is just going to remain under pressure for a little while.
And there's still a lot of things overhanging this company too, right? Like various probes that still need to be worked through.
Yeah, and that's going to take a long time to play out. We've seen some of these probes. I mean, often when the settlement pops up, you kind of almost forgot that was happening. So these things go on for a long time, and there's a lot might come out that might affect the company. So as they figure out how to get the business into the right size to navigate what's going on in the here and now, they still have some of that recent baggage.
Is regulation also, has that been a problem? One big beautiful bill had really adverse effects for other healthcare companies. Was it the same for UnitedHealth?
That's going to be an issue that plays out as the Medicaid stuff is going to come in the next couple of years, but it's going to be a big issue across healthcare for insurers, for hospitals. I think there are a lot of ways that could continue to hurt the healthcare system, and we'll see it show up in earnings in years to come.
All right, Cynthia, thanks so much for joining us. Cynthia Coons runs our health care coverage for us here at Bloomberg. Take a look at what's going on in stocks right now. As you just saw a moment ago, little change on the S&P, but the NASDAQ continues to rally. The Russell down 0.7%. Coming up in the next hour, Goldman Sachs' David Kostin will talk to us about whether or not he sees 7,000 as the base case going into 2026. Plus, Apollo's Scott Kleinman talks credit and its deal to fund Keurig. Dr. Pepper's takeover of JDE Pete's, and Merlin CEO Matt George will talk to us about automating flight. didn't that happen like 50 years ago? We'll get the update. This is Bloomberg Open Interest. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Danny Berger, trading at highs but losing some of the steam of the earlier rally at the open.
Yeah, absolutely. We've had company after company that's done very poorly over this last year or the last 5 years, putting out earnings or announcements that boost the stock for the day. We're getting economic data as well right now. The Conference Board Consumer Confidence coming out at 94.6, which is better than the 93.4 that we had expected or that we had gotten in a survey of economists. There's also other better news, I guess, than had been anticipated. The Richmond Fed Manufacturing Index, for example, was only negative 0.4, and we were looking for it to be negative 12. So I guess that's good news in terms of the consumer outlook. Or at least better news than was expected?
Yeah, I mean, I don't know. You could read this anyway. The Conference Board expectations also is weaker than it was last time. It was 73.4 last data point. Now it's 71.5. So you could kind of go either way. It's this confusion about the consumer. Does it get worse with layoffs being announced? Well, let's stay with the consumer. And Goldman Sachs CEO David Solomon shared his outlook on Bloomberg TV.
Businesses that are particularly sensitive to lower income or paycheck to paycheck consumers have been a little softer. And I would say, consumers that are paycheck to paycheck feel more pressure in an environment with 3% inflation. And so there's no question inflation is very, very difficult for people who live paycheck to paycheck. And so it's something I think we have to watch very carefully.
Let's bring in David Kostin, Chief U.S. Equity Strategist at Goldman Sachs. He's bullish on stocks with an S&P 500 year-end target of 6,800. David, we'll broaden out to some of those consumer comments in a moment, but we have to first start with the elephant in the room. You are bullish on stocks, but we've already surpassed 6,800. Are you looking at raising your price target for this year-end?
Well, I think the thing you really have to start first is looking at earnings. What's happened to the results so far for U.S. corporate companies reporting? With looking at expectations was around 6% year-over-year growth. It's coming in 8% for the full year. The market's looking pretty strong in terms of the profit growth, and that's really been the story and the trajectory of the index. The broader index has been following the path of earnings. We're expecting earnings to grow into 2026. The expectation is that the Fed is likely to be cutting both this week and then in December and then twice next year. So that's 4 Fed cuts, and that's generally speaking been a tailwind for stocks when the Fed is in an easing mode, as long as we don't go into recession. That's not part of our forecast, meaning that we're expecting the economy to grow. The Fed's easing, and you have a environment where corporate earnings and guidance continues to be pretty robust. So I think those are the building blocks. When we look out, a year's time, roughly 7,200 is a target that we published, and I think the backdrop remains pretty solid for equities in that context.
So, okay, so your target is 7,200 for a year out next year, in October, November. What about earnings growth for 2026? Because you just said you're expecting now 8% for 2025. And is that a little bit of a slowdown? And does that slowdown continue in terms of earnings growth into next year?
Well, Matt, just to clarify, so the first half of the year, earnings were up 12% year over year. Expectation on consensus was around 6% for this quarter. And it's coming in roughly 8%. So we're getting a positive surprises. That's been pretty consistent in the last sort of 8 quarters, last couple of years, roughly 4 percentage points positive surprises versus expectations. And we look out this year, into next year, probably 7% is our baseline number. And probably the risk of that forecast is probably to the upside as opposed to the downside. I think the issue to think about is companies are really ramping up their CapEx. And so we look at the capital spending growth year over year is going to be this year, or looking into next year for 2026, be greater than the amount of capital they're directing towards buybacks. And I think that's indicative of the fact that a lot of corporate managements are pretty optimistic around their fundamental business, the potential for AI and adoptions that they're trying to do in different areas of their the business practices. I think those are, generally speaking, Matt, some of the reasons why, from an earnings perspective, companies are likely to continue to grow their profits. And over time, that has been the driver of equity prices. Earnings drive stocks over time, and that's pretty optimistic. Last week we had a Goldman Sachs event in California. We had 100 members of the venture capital and private equity community. A lot of those businesses, of course, really those professionals, very optimistic about the fundamentals. And they're also looking at what's happening in the IPO market. We've had a pretty robust IPO market thus far this year, about 50 transactions. The average deal's up nearly 30% on the first day's trading, so they've done pretty well. Obviously, with the shutdown of the government, a lot of that has been on hold for some of the transactions coming up. But the idea of capital still coming to the equity market, our sentiment indicator is still, in terms of positioning of market participants, still on a relatively muted level. So there's still potential capacity for purchasing there. So those are some of the drivers, both on an earnings perspective, on a capital flow perspective, that would make us pretty optimistic with respect to the trajectory of equities. Obviously, the valuations are high.
If I could just jump
25 times earnings.
In terms of what's driving things, because yes, it is earnings, but if you look at the big weights of this market, and that is the hyperscalers, the big tech stocks are reporting this week, they're not necessarily getting rewarded just for fundamentals or earnings growth, but rather investment spending. Can that continue? Can that continue to be a reward and a driver for big cap tech, and thus the entirety of this market?
Well, I think it's important, Danny, to focus on the fact these are the publicly traded companies where they have, generally speaking, lots of cash flow generation and very strong balance sheets. So from a sustainability perspective, the likelihood is, yes, they could continue to maintain their capital spending and leaning into their investments, particularly in AI. If you think about the developments in the last couple of years, expectations coming into the year were roughly a 20% or so increase year over year in CapEx budgets. That was the story in 2024, thus far 2025, but they're coming in closer to around 50% growth. That was 50% growth year over year in CapEx spending for the big hyperscalers. That was 2024. The experience thus far, same. And we look at the 2026, expectations are still around 20% growth. And the view of Goldman Sachs is that's probably low, and you're likely to get some positive surprises. And the idea of spending CapEx out of cash flow generation is likely to continue. Now, that's really the story in the publicly traded market. The private market, it's a little different story. There is a requirement for a lot of these companies to continue to attract third-party capital to continue their investments. And that's obviously an area of great focus and investment and debate with portfolio managers, whether that ability to attract capital is likely to persist. And so the focus in the public markets is still pretty optimistic about their spending. And that's their spending is someone else's revenues. And that's, I think, an important story behind why the companies who are part of the AI infrastructure build-out, those stocks have done terrifically this year. And I think that's a testament to what's the fundamentals around what's driving them in terms of their revenues and their earnings growth.
David, I have a viewer writing in with a question about GLD, which is, I know gold, not your wheelhouse, but technically it's an equity, right? Because it's an ETF. What happened there with that huge run-up? I mean, was that just hedging? Was that investors trying to buy insurance against, fiscal overrun? And what's happening now? Like, if stocks continue to go up, is that bad news for GLD?
Well, we have a commodity strategy team. Dan Struyven happens to sit in the office right next to me. And one of the arguments that they've been identifying is the increased demand by central banks, foreign central banks, to hold gold reserves. And that is one of the sources of demand. And so I think that's the argument behind a gold price in the forecast likely to increase in the next 12 months, 3, 6, and 12 months out, still higher. And I think that's the broader fundamental view. The Fed is likely to cut rates as well, and so that's a view from a lot of investors concerned about uncertainty, geopolitics, et cetera, has been one of the reasons. But I'd emphasize the shift in the central bank balance sheets that they're allocating more capital to gold.
David, great to get some time with you. Really appreciate it. David Kostin there of Goldman Sachs talking to us about this market, which sits at highs pretty much no matter what benchmark index you look at. And that's the case right now as well. 68.80 is the level, 0.1% higher on the S&P only, but how far we've come and how fast it's been. The NASDAQ up 1/3% as we get bigger boost from tech stocks making deals with OpenAI and payment platforms as well. And then the 10-year yield right now sitting just under 4, but headed up as investors feel comfortable enough to sell off this debt, even though they likely expect a rate cut tomorrow.
Yeah, but how much is that already priced in, I guess, is the question. That gives you some movement on treasuries. And look at some of the single stocks moving this hour. We are watching shares of Apple, which have fluctuated a lot this morning. It's currently unchanged or a slight decline. It did briefly hit $4 trillion in market cap, joining the club alongside NVIDIA and Microsoft.
So Microsoft, I was going to ask, did Microsoft hit $4 trillion as well? And
so, yeah, Microsoft is currently at $4 trillion.
4.063.
It's never closed at that level, I believe, but it has hit it before.
All right. Microsoft getting a boost, as we mentioned earlier, from that OpenAI agreement. It's set to get 27% of the, what did you call it? There was an acronym.
PBC, Public Benefits Corporation or company. I might get that wrong.
There you go.
I know it's PBC.
So Microsoft making a deal with OpenAI. PayPal also striking a deal with OpenAI, becoming the first company to add its digital wallet to ChatGPT.
And UPS smashes Wall Street profit expectations, says it has cut 34,000 jobs so far this year. Those shares up 7.5%, and as Matt has highlighted, have been an underperformer otherwise this year. Coming up, President Trump deepens ties with Japan. We're live in Tokyo with the latest. That's coming up next on Bloomberg Open Interest.
Let's get now to high interest. Look at what's making headlines around the world. ADP Research will now release weekly U.S. payroll updates, offering a faster read on private sector hiring while government data is frozen by the shutdown. The weekly figures are a 4-week moving average of the latest total private employment change that will be released on Tuesdays at 8:15 a.m. Eastern. ADP will continue to publish as well its monthly estimate. And Hurricane Melissa is closing in on Jamaica as the island's most powerful storm on record. The Category 5 hurricane is packing 180-mile-per-hour gusts that could dump up to 40 inches of rain. Forecasters warn much of western Jamaica could be flattened when Melissa makes landfall this afternoon. Officials have closed ports, airports, and ordered evacuations as the nation braces for devastation. President Trump is hailing America's alliance with Japan and praising new Prime Minister Sanae Takaichi's defense spending as the pair meet in Tokyo.
This will be a relationship that will be stronger than ever before, and I look forward to working with you. And on behalf of our country, I want to just let you know, anytime you have any question, any doubt, anything you want, any favors you need, anything I can do to help Japan, we will be there. We are an ally at the strongest level.
Trump also offered optimism that the two sides had overcome their trade differences. For more on President Trump's meeting with Japan's Prime Minister, Bloomberg's Washington correspondent Tyler Kendall joins us now from Tokyo. Tyler?
Yeah, hey, Matt, good morning. Well, it is clear that the U.S. is trying to secure as much leverage as possible ahead of the talks with China on Thursday, as President Trump was piling on the praise of the new Japanese prime minister. Now, the new prime minister has only been in office for a matter of days, so not much time to prepare for President Trump's visit. But it is clear that she took some concrete steps ahead of time that perhaps paved the way for success. That includes Japan announcing that it's going to expedite its pledge to boost its military spending to GDP, something that was broadly applauded by this White House, as President Trump himself came out and said that he secured a promise from the new prime minister that Japan would start to boost its imports of U.S. military supplies. That was just one in a series of headlines that we received today, appearing to bolster the U.S.-Japanese alliance, but also to counter China. We saw the U.S. and Japan sign an agreement on critical minerals, as well as a memorandum of understanding when it comes to shipbuilding, as China currently currently accounts for more than a third of the global fleet. It is all in a bid as we gear up to, of course, the important meeting on Thursday that we are looking ahead to when President Trump sits down with Chinese President Xi Jinping. I will also quickly add that we did get some additional details when it comes to the planned investment fund from Japan, a $550 billion pledge. We saw President Trump host a leader reception today with business executives from across the world convening here in Tokyo. He highlighted the likes of some Japanese companies like SoftBank and Toshiba.
Tyler, thanks for staying up late for us. Looking forward to your coverage of that meeting between President Xi and Trump on Thursday. Bloomberg's Tyler Kendall reporting from Tokyo. Turning now to corporate America, where job cut announcements are starting to pile up. UPS, the latest, saying that this year they'd cut a total of 34,000. They add to a growing list of companies announcing job cuts in recent days. Joining us now is Stuart Paul, U.S. economist for Bloomberg Economics. And Stuart, I mean, take your pick. It's Amazon, Target, Applied Materials, Charter Communications, Nestle, that just scratches the surface. What is signal and what is noise from these companies?
It's really difficult. When you have a lot of these high-profile layoff announcements, we can make a lot of hay out of it. Finding the macroeconomic needle in the haystack is a little bit harder. I like to focus on each individual announcement and suss out what's idiosyncratic to the company. For example, layoffs at Paramount, pretty idiosyncratic, given the merger and reorganization with Skydance. When you get to something like UPS announcing that it had shed so many jobs, let's face it, some of that is downstream from labor renegotiations and contract disputes in 2023. It's shocking to see how many jobs have been shed. Something like Amazon, it looks like it's more structural, and it looks like it has more to do with implementation of AI, reverberating through some of management and reverberating through some of the headquarter operations.
I wonder, if we should expect more layoffs, considering the fact that AI is clearly going to be replacing jobs at companies like Amazon. Danny yesterday was talking about the fact that, Amazon eventually wants to cut 600,000 jobs because it can replace them with AI. Plus the fact that so many economists have warned companies are going to be beefing up margins that have been hit by trade tariffs.
Yeah, so when you look at a company like Amazon, if you look at the IT and just information industry as a whole, it actually does not look like they're especially bloated with workers, and it doesn't look like there's going to be a rush to replace people with AI. It looks more like it's the case that implementation of AI paired with attrition of existing workers is what's driving labor demand and labor supply in that particular arena. So I don't really expect to see a surge in layoffs due to the implementation of AI. But we can expect to see additional labor efficiencies in those industries where they are implementing it. For example, in information, relative to pre-COVID, headcount has increased by just under 1%. Output, as measured by real GDP in the industry, nearly 25% increase relative to pre-COVID. So you already are seeing the ramifications of AI implementation there.
If it does, though, lead to job cuts, isn't that a huge issue? Because Fed rate cuts aren't going to bring back jobs that have been impacted by AI.
That's right. And that's exactly the sort of structural problems we need to try to suss out. And you're right, when we have such a tenuous balance in the labor market right now, if we were to see any sort of acceleration in layoffs, it would be a major problem, and it would result in rising unemployment, materially rising unemployment. When you look at the ADP numbers released today, it looks like hiring is running at about half the break-even pace needed to maintain a steady unemployment rate. You're right, if we were to see real material layoffs, it would result in accelerating unemployment. But when we look at warn notices, when we look at early indications of what we can expect for layoffs 90 days out, we're still running at a pretty low level, just about 20% higher than where we were last year.
Stuart, what about adding jobs? I mean, the whole point, or at least part of the point of these tariffs, was to bring manufacturing back to the U.S., to add jobs to the U.S. economy. And I would imagine it's been successful, at least in part. Automakers that were building cars in Ontario or building cars in Mexico have moved a lot of that production to the U.S. Are you not seeing substantial manufacturing jobs come back to the U.S. economy?
We have not seen a major increase in manufacturing jobs. We have to keep two things in mind. One is that tariff benefits are relatively concentrated, but the effects, the consequences are really diffuse, and tariffs are growth negative. So even if you do have concentrated benefits benefits in some industries, you could still expect to see at least slowing hiring and a more broad-based scale when you look across industries. Second, when we have implementation of tariffs, you end up having the snarling of supply chains. Matt, I know you're a car guy. When you have aluminum imports disrupted, when you have aluminum manufacturing disrupted, you can expect slower delivery of Ford F-150s. We're expecting to see that show up in industrial production data as that affects manufacturing.
As we're sort of in this, data vacuum, I guess you could call it, without the official government data, I know ADP this morning started to put out what they're going to have as weekly figures. How useful is that for you for a signal? And what else are you looking to right now?
Look, I'll take anything that I can get at this point. More data is better. Any additional information I find useful right now. But when we're looking at moving averages, specifically in the private sector, it's not going to be as helpful as the monthly figures. But look, everybody is training their nowcast models. Our nowcast models are going to be incorporating the weekly figures also. And so I'm looking forward to incorporating additional alternative private sector data sets.
You're adding it to your AI model? You have an AI model?
We have nowcast. We deploy AI in developing our models, but it's not as though we have AI specifically building our models.
Okay, interesting stuff.
It hasn't taken jobs yet here at Bloomberg Economics.
Stuart Paul still works here. From Bloomberg Economics, we appreciate your time and your intel. Still ahead, more on AI's impact on the workforce. We'll speak with the CEO of Merlin, Matt George, as the U.S. military moves closer to fully autonomous flights. This is Bloomberg Open Interest. Get a check on the stock market right now, and you can see that we're still gaining, but only about 7 points on the S&P 500. In fact, the breadth is pretty bad. 130 stocks up, 371 stocks down. We had a spike at the start of trade because Microsoft announced its new deal with OpenAI to sell $250 billion worth of Azure cloud services, but then we steadily trailed down. We're coming up a little bit. Microsoft, the biggest gainer, NVIDIA, Tesla, Broadcom, all up today. PayPal also has an announcement with OpenAI. On the downside, you've got Google, Berkshire Hathaway, as well as Qualcomm and Royal Caribbean, plus Facebook. By the way, if you look at the industry groups, it's really like only tech is holding us up right now. In fact, it's IT as the biggest winner. We also have consumer discretion up a little bit, but otherwise, communication services isn't even gaining right now, and the rest of the industry groups are off. Coming up, deal activity is picking up, and Apollo is in on the action. We'll speak with Apollo's co-president, Scott Kleinman, next. This is Bloomberg Open Interest.
There's no question M&A and IPO activity have been accelerating. I think they'll continue to accelerate in this environment. I think there are different reasons why there were headwinds over the course of the last handful of years. If you wanted to do large, interesting strategic things, one of the first questions was, can we? And no matter what the question was, the answer was generally no. We're now in an environment where the question is, can we? And the answer is generally maybe to potentially yes.
Goldman Sachs CEO David Solomon speaking at the Future Investment Initiative, and Apollo and KKR are getting in on that pickup in deal activity. Keurig Dr. Pepper raising $7 billion from the two to help finance its acquisition of JDE Peet. Apollo and KKR will invest $4 billion in a coffee pad manufacturing JV, in which Keurig Dr. Pepper will retain a controlling interest. I'm pleased to say, for more on this deal and much more, we are joined on set by Scott Kleinman, co-president of Apollo. Scott, great to see you this morning. Thanks for joining.
Thanks. Good to see you guys as well.
So this deal from Keurig Dr. Pepper, they first announced that they were going to do this back in August, but it was only yesterday that we learned of yours and KKR's involvement. What was the genesis of this deal?
Yeah, well, look, the transaction itself, I think, has been well articulated. Makes a lot of sense bringing these companies together. Our involvement really stemmed from, the need for the company to find creative ways to bring its leverage down, and we came up with some, with the company, some very creative and thoughtful ways to make investments in the business, but also do it in creative ways that really only private capital can solve.
I wonder about secondaries. It was initially, when we started talking about it in financial media, we were skeptical. But now we've seen huge fundraises and secondaries. Investors clearly want access. Was that a big part of this funding, this financing as well?
No, not really. This really comes from a lot of our balance sheet capital, a lot of our hybrid capital that just is looking for interesting ways to make investments, but in a safer, more downside protected way.
It was indigestion in this industry, and as we heard from David Solomon, and clearly just alone in the action Apollo is doing, things have picked up. I remember in the summer of 2024, you stood up on a stage in Berlin and told everybody, I'm here to tell you that not everything is going to be right, at least until the pig made its way through the python. I think that is one of the best statements about the industry that's ever been made. Where are we now? Has the pig made its way through the python?
Well, thank you for that. It's nice to be right once in a while. No, I'd say the pig is sort of somewhere like passing through the small intestine or something like that. No, the reality is, as we said back then, that the low rate environment for a decade allowed the private equity industry to, acquire some really good companies, but at pretty full prices. And when you saw a fundamental rate environment change, all of a sudden those good companies are still good companies, but they were purchased at prices that don't make sense anymore. And so it was just going to take a while for companies to grow into those valuations longer than I think was underwritten. And that's exactly what's happening. And so, we do believe, the thing I said at the time also was that we're going to be in a higher for longer rate environment. I think there was a lot of optimism that rates would come down pretty quickly. Rates are starting to soften, but still we believe the rate environment is going to stay higher for longer. And that's going to then, keep the prevailing valuation environment, intact. And so, yeah, I think you're going to watch, private equity sponsors sell assets, but at a slower pace for the next few years. Yeah.
Also, how great is it that a New York-based television anchor quotes you from Super Return in Berlin?
We're international.
We're deep in it.
There you go.
That's the point I want to make. You've reopened windows, right? Aspen Insurance, Lottomatica, and you're seeing exits here. Are exits back? Is that going to lead to better fundraising for 2026?
Well, look, here's where I'd be remiss if I didn't, put a shout in for Apollo. I mean, part of the reason we've been able to be, exiting a number of our companies is because, I joke we never got the memo that the interest rate cycle was going to last a decade, and so we stayed true to that more value-oriented investing environment, and that allowed us to buy companies at, lower prices, good companies, so that when we are starting to exit now, we're not dependent on those expected high valuations. We can get out at reasonable valuations and still make the investments good. When folks say that it's a tough exit environment, it's not that it's a tough exit environment. It's a tough exit environment at prices they would be happy with that justify their purchase prices. So if you've paid reasonable prices for assets, you absolutely can get out now.
Well, there was that frenzy against, again, what you're referring to in 2021 and 2022, where people paid a lot. If you look at the volumes, they're starting to rival that, the third quarter especially, and I guess a lot of that has to do with a big LBO in the way of EA. But are we at risk of making that mistake again with all of a sudden this over-enthusiasm and people coming back to market and happily snapping up some of these deals, especially the tech-oriented ones?
We'll see. I can't really speak to the EA deal. It obviously a huge company, a huge price. But no, I think there is definitely some enthusiasm building for some of these businesses. But of course, you only have to look at the market today to see that there's a lot of momentum, perhaps over momentum in certain of the tech-related spaces.
So you are seeing some froth there then?
I would think so. Yeah, I would think so. Although it's still, because of the rate environment, you can only go so far in the buyout side of it. But certainly a lot of enthusiasm.
Can I just ask on that? Because on the tech side, when you've done AI deals, Apollo's been very deliberate in that it's been on the financing side of it, not on the equity side of it.
Right.
Why structure it that way?
You know, I'll go to the old adage of, you know, we'd rather be selling pickaxes to the gold miners than doing the gold mining ourselves. And, you know, we have enormous pools of capital, including our own balance sheet capital, that is looking for a little bit safer, downside protected. And at some of the valuations we're seeing right now, it's sometimes hard to wrap your head around the equity story, whereas either the financing story or the structured investing into those, you can get a lot more comfortable with the risk-return balance. We are huge believers in the AI story going forward, meaning volumetrically, AI is just seeping into more and more parts of the economy and will continue, you know, for the foreseeable future. But people confuse the volume story and the value story, right? Just because volume's going up doesn't mean the profits that we're seeing today in the earliest days of AI, where there's supply shortages, bottlenecks, et cetera, for different components in the value chain, that eventually will correct itself. And we've seen this in the PC revolution, in the internet revolution, and we know it'll be the case here. I just don't know if that's 1 year, 3 year, 5 years away. And so we tend to take a more thoughtful, downside protected approach.
You do have, though, a lot of equity stakes. And whenever I'm talking to men and women that work in PE at like the neighborhood barbecue, I'm always asking about portfolio companies, because I think it's a great, you have a fantastic vantage point on the American economy, on the global economy. How does labor look to you right now? I mean, are you reducing headcount at a lot of your portfolio companies because you can replace some of what they do with AI?
You know, it's the most important question, you know, out there. I think you're seeing, like in a lot of parts of the economy, the answer is both, right? So in some parts of our companies, you know, there's still a labor shortage. There's still not enough. We're still not at full employment. In other areas, certainly the lowest hanging fruits, you're starting to already see those productivity gains happen. You saw some of the announcements today from some pretty big companies. I think you're going to be seeing that's going to become much more of the regular type of discussion that you're hearing on quarterly earnings, because it's, you know, we're now a couple years into this AI activity, and you're starting to see the fruits of all that investment. But even that is still early days. It's really most of the more obvious parts where you're seeing labor reductions. A lot of AI, certainly within Apollo, a big part of the AI is how do we drive productivity? How do we get more spread out of the credits we're writing? How do we make better decision making? How do we make better risk decisions? And so it's really all of the above.
A lot of these tech companies, though, when you hear deals from them, it's been flagged as some maybe not traditional deals where you're investing in a company, OpenAI is, and it comes back in the form of revenue. There's been this argument of circularity. You are a deals guy at heart. When you look at some of them, does it make sense to you? Does it concern you?
Look, it's not my area of specialty, so I'm not going to really opine. But clearly, a lot of folks are creating a lot of value on paper, you know, right now, and even more than on paper. At some point, these type of things usually lead to, you know, one set outcomes. But for the time being, you know, back to what I said, that value versus volume disconnect. There's a lot of money to be made along the way, but the problem is when it flips over, you're kind of whoever's left sort of holding the bag, you know, rides it back down. And so, yeah, maybe we'll leave it there.
Well, it's great to get your take on the whole thing, Scott, and great to have you in here. Thanks so much for joining us. Scott Kleinman there of Apollo. Coming up, the U.S. military is moving closer to fully autonomous flights. Merlin CEO Matt George is one of the people working to make it a reality, and he joins us next on Bloomberg Open Interest. Military entrepreneurs are pouring into Massachusetts. State officials announced $47 million in funding for defense-related projects, trying to cash in on record VC investments in the sector. Joining us now is one of those companies. Merlin is a Boston-based aviation technology company focused on AI-powered autonomous flight technology. The company's CEO and co-founder, Matt George, joins us now. Matt, I want to talk about Boston. I want to talk about what you're doing. But first, about autonomous flights. for those of us who grew up with the movie Airplane, isn't that already happening? Like, aren't drones essentially that?
Yeah, airplanes have been flying themselves since the 50s. So we're lucky at Merlin that we got to start the company essentially on second base and start to bring AI and other elements to the system that just advance those capabilities versus having to go bring it from the ground up like some of the autonomous car folks have done. What that means, though, is we've been able to produce a lot of capability for proportionally few dollars and in a pretty record amount of time to actually get it fielded to our customers.
Can you just help us understand, like, what is the difference to have these using AI versus what we were doing before? What actually changes?
Yeah, autopilots are pretty simple. They're still generally following waypoints and kind of similar to a level 2 or a very simple cruise control sort of type system in a car. By layering on additional AI skills, you start to go from just following a line in the sky to being a little bit closer to making some decisions, being able to go handle emergencies, talking to air traffic control, being able to route around weather. So some of those higher level functions that are performed by pilots today, what we're doing is we're augmenting those pilots with higher levels of AI, in addition to more traditional autopilot systems, to go deliver some pretty fundamentally new capabilities to our users, particularly in the military.
And you've got at least $100 million in defense prime contracts. You're going public via SPAC and getting more funding through that. What's your ambition? What's your 5-year plan look like, Matt?
Fundamentally, we believe that the next 100 years of aviation are going to be built around autonomy. So just like the previous 100 years of aviation were built around the concept of an airplane plus a pilot, we think that there's going to be truly generational companies built around being the prime or the main producer of autonomy for aviation. And we're super blessed to lead that field as the leading developer of autonomy for fixed-wing aviation and building that ecosystem around us.
Matt, what's the biggest bottleneck? Supply chains, talent, regulatory delays? What could hold things up?
Yeah, a little bit of everything. So for us, our biggest bottleneck, and it's an understandable bottleneck, is making sure that we build trust and confidence in the system, both with our customers and with the regulator. So we're super proud of the fact that today we announced a pretty major regulatory milestone in passing of our SOI 2. So we are leading the industry in getting certified autonomy actually out into the hands of users. And we're proud of the fact that we're beating some of the big defense primes like Boeing and Lockheed and others in getting that done from a little company here in Boston.
I see the Charles there behind you. I wonder about the importance of Boston. We've been talking to a lot of defense contractors, growing defense contractors in that area. Why do you think it's such a potent breeding ground?
Yeah, not a green screen, by the way, which I always thought. But Boston is a really, really, really important mecca for aviation. At MIT, behind us, we have one of the top aviation programs and aerospace programs in the world, and that's bred a lot of talent. So we think it's really important to belong Boston, and we think it's really important to build here, and we think we can get asymmetrically more done here in Boston than we can in any other place in the world.
In case you were confused, in our studios in Boston, no green screen. It is a screen behind me. That's not actually what New York City looks like, in case anybody was confused. Hey, Matt, you mentioned Boeing. There are a lot of legacy primes, a lot of competition for you, not just Boeing, but Lockheed Martin, Northrop, GE. The list goes on. They have deep scale. How do you differentiate?
One of the things we've been proud of as we've come to lead the market has been that those companies have started to work with us. We announced a huge partnership with Larry Culp and GE and the entire team at GE Avionics to partner with them to go bring autonomy to the thousands of aircraft they already serve. We also announced a partnership in New York with the Northrop Grumman folks, where we're teaming with them on their new collaborative combat aircraft. So we fundamentally believe that it's important for all of us to go team up together. And now that we're leading the pack, we're proud of the fact that we're able to get some of those big folks to not compete with us, but to work with us to go deliver those capabilities to our joint customers.
I want to ask about, I know you're a pilot as well, Matt, right? And it's pretty daunting to go after your private pilot's license now. When I was a kid and I got my driver's license, I had to do it in a car with 3 pedals. People who do it now only have 2. Is your technology, you think, going to make it easier for regular citizens to fly a plane?
One of the things we're also really proud of is the fact that we can go take the Merlin pilot and adapt it even to small aircraft to make those aircraft a little bit easier and, more importantly, safer to fly. Flying small aircraft is still really dangerous. The accident rate is through the roof. So anything we can do to simplify those vehicle operations, particularly on small aircraft, is important not just for the industry but for safety. And using that same common technology is the same stuff we're using all the way up to those big airplanes. So by investing once in that common autonomy brain, we're able to apply that from everything from small Cessnas all the way up to some of the largest aircraft in the world.
Matt, interesting stuff. Thanks for joining us this morning. Matt George of Merlin. Coming up on the show, stocks linked to uranium and nuclear energy are gaining on U.S. investments, Google investments, then piling in to clean energy. That's next. This is Bloomberg Open Interest. Uranium and nuclear stocks are climbing today after the U.S. government signed an $80 billion nuclear reactor deal with Westinghouse Electric. Meanwhile, Google inked a 25-year agreement with NextEra Energy for nuclear power. Bloomberg energy reporter Will Wade joins us around the desk. Will, let's start with the government side of things. An $80 billion deal. What are the details behind it?
Oh, that's a really good question. I don't know the details.
Okay, great.
They didn't really give us a whole lot of information on the details. One of my sources said it seemed purposefully vague. It'll probably be grants. It'll probably be loans. It could come out of the Loan Programs Office, which is a government arm just for funding big energy projects. But they haven't really said exactly how this is going to work. It's a big pile of money. I don't know that they've got $80 billion laying around.
If you build it, well, no, you have to have the money to build it first before they come.
Then maybe they come, yeah.
But some companies are restarting, famously 3 Mile Island, 1 reactor there, and now NextEra is restarting a nuclear plant, Duane Arnold
right,
in Iowa.
Mm-hmm.
Are we going to see much more of this? Are there any other dormant giant nuclear plants around ripe to be reopened?
So I'm going to say no right now because I've actually researched which ones could be restarted, and that's pretty much the whole list. There's 3 Mile Island, there's Santee Cooper's VC Summer, which last week we heard a deal about. There's the Palisades plant in Michigan, which could come online in the next few months. There's 3 Mile Island. There's this Iowa plant, and that's kind of the end of the list. But the interest in nuclear power is so strong that we could see things happening.
How long, though, does it take to have things, not just agreements, but for these plants to be up and running, for actually to produce the energy needed? What is the delay and the time gap between the energy need we have now and when actually we'll be able to use these nuclear power sources?
So for restarting a dormant plant, a couple of years, which is way shorter than building one from scratch. That's why it's so appealing to big companies. All these big tech companies for the data centers, they want power yesterday. So a revived nuclear plant in a couple of years is attractive.
What's the delta look like between the amount of power we generate now, I mean, across all sources, right, and what we need for, our AI ambitions? Is it massive?
It's massive. We've seen all kinds of forecasts for how much power demand is going to grow up over the next several years. I saw a stat this morning that data centers by middle of next century could be 9% of the entire U.S. energy grid.
You report on this globally, and I understand that it will take some time to come up here, but just looking at a place like Europe, I mean, where does Europe get the energy sources from? It seems like we have riches here in the U.S. for that, but what about other places in the world?
Europe's got a lot of renewables. They've got all the offshore wind. The place to look really, though, is China. That's really where they're putting so much money and effort into building nuclear power plants. They're really taking the lead.
All right. Will, great catching up with you, and I love to read your reporting. This is a fascinating topic, not just for me, but I think for everybody in the markets now. Who would have thunk? Who would have known, right? Did you know this was going to happen? Could you have guessed?
Yeah, I guess this about 18, 24 months ago.
Nice. All right. Will Wade on nuclear energy that we need to fulfill the demand. Let's get a look at what's going on in the markets right now. Not a lot of movement. 68.82, though, would be a new high. Tomorrow, Sheila Kahyaoglu joins us from Jefferies, following earnings from Boeing, plus Liz Ann Sanders of Charles Schwab and Henry McVeigh.